Welcome back into Cloud's Retirement Chat. I am John Gay. I'm joined again by Tommy Cloud. Always good to be with you, my friend.
Well, thank you for saying that, John. It's always good to be with you as well.
So we are talking about gold and silver today, Tommy. And I think one of the big things that people are asking about, or one of the big reasons people are asking about it, is with the volatility we've seen in the market in the last, year plus since the pandemic started. Gold and silver seems to be something people are asking a lot more about as maybe stability or a way to diversify. Where do you want to start here with silver and gold?
Well, there's a lot to say there. This is something that I'm familiar with. I grew up with a dad that was in the tangible assets investment market. He sat on the board of Intercap, which at the time was one of the largest mutual funds in the U.S. Back in the 80s. And he began his career in real estate, and then he bought a gold company in 1988. Mm-hmm. And so that was my first kind of stage in life to start learning. I was 14 years old.
Okay.
And he started talking about money printing and fiat currency and Kondratiev waves and the Elliott waves and Keynesian economics and all of these.
When I was 14, I was looking at baseball cards, but to each his own.
Right. That's right. That's right. Well, I was kind of forced into it. He didn't force me to study, but he was talking about it, and I've had interest in it. So here we are 50 years later after coming off the gold standard. And, gold has been a really good performer for people that have held it. But when I say performer, it doesn't just mean return, John. It means as well as the non-correlation that it has to global stocks. And that's very important to have.
Before we get to that, Tommy, Can you just back up for a second? And for our listeners who aren't familiar with the gold standard, can you explain that quickly?
For years in this country, our dollar, our currency, was backed by gold. What does it mean to be backed by gold? Well, it means for every dollar of currency, we had an ounce of gold. And our currency was very stable during that time. And we've always had inflation. We didn't really see the hyperinflation with our currency being backed by gold that we saw in the 70s. And really, with more recently here in 2020 and 2021, we've seen the government literally print trillions of dollars, and it has caused price inflation. It's caused people to want to stay unemployed for longer periods of time. And on a side note there, I have a client who had a very successful career at Hitachi. And, he was the number one salesperson. I started working with him when he was 48. He's 63 now.
I think you've mentioned him in the podcast before, actually.
Yeah. I was talking to him this week or last week, and he's like, Tommy, I'm getting $1,000 a week on unemployment because the state that he lives in is also chipping in to what the federal government's giving him, and it's what we're seeing is people just aren't really working right now. But going back to the gold standard, it's a way to kind of hold currency accountable. Those gold coins used to be worth $1, and now, of course, they're worth $2,000. And it's one of those things where the government wants control. They want to be able to tighten and loosen, and of course, we've been loosening so long, and with such fervor that now we're at a point where interest rates are almost zero, and our dollar is not purchasing what it used to or even close to it. Now you could say, well, it held its value against other currencies, and that would be true. However, it's like which snail is the fastest. We're not trying to judge ourselves against other world currencies. I think we're trying to judge ourselves against excellence. And I think when we were on that gold standard, we had a much more stable currency, and it was by far. It still is the world's reserve currency, but that's coming into question. But up until the gold standard, our currency was viewed as much more solidly than it is now. I remember these discussions with my dad. Not in the 70s, I was too young, but certainly in the 80s, he began discussing these things. I heard him talking about it when I'd go to his office during the summer and that type of thing.
So the gold standard, changes over time. And where are we at now as far as people are talking about investing in gold and silver?
Well, I think people are still, even though it's one of the most liquid investments in the world, trading, 100 and I think it's 45 billion, $145 billion a day, which is only surpassed by the S&P 500 and U.S. Treasuries. That's when you're the third largest in volume on daily trading of any, assets. It's pretty impressive. Of course, the S&P 500 is just the 500 largest stock. So
Right.
as you get into global stocks, small cap stocks, mid cap stocks, that's not going to hold true. With gold and silver, it's one of those things where, it's gold has gone up and expanded over the last 50 years since it's come off the standard in August of 1971. It's expanded more than 46 times. And so,
Wow.
if you would have put, let's say, $1,000 into gold in 1971, it'd be worth $46,000 today, so that's, pretty good. That 10,000
I
would
would
be
say, yeah.
worth 460,000 today.
Right.
That's about 8% a year. I looked at gold from May of 1975 to 2021, about a 46-year time period, and gold had returned about 5.37% a year compounded versus stocks during roughly the same time period had returned of 9.25%. So stocks were a little bit higher. But here's the thing. As we look at gold and silver, if you put gold together, and by the way, silver was 51 cents in 1915, and in February of 2021, it had grown to $27. So,
It's funny, people talk about gold and think about the gold standard and how valuable gold is and everything that comes along with gold. But people don't realize, I think, Tommy, is that silver has a lot of value too. As we do more and more with technology and computers and all these different, moving parts and machinery and microchips and so many other things, silver has really become a big deal as of late.
it really has. If you look at it, like I said, over the past 106 years, it's had a return of about 3.83% per year, which is pretty darn good on average. If you look at what you're talking about, John, is with silver being an industrial metal, whereas gold is a monetary metal. So silver is probably more moderately correlated to the S&P 500, whereas gold has no correlation. It might be a moderately low correlation for silver. However, it is more considered dependent upon economic growth, where gold's considered more of a defensive metal. So that's kind of the difference between the two. As we look at these two assets and whether or not they're good investment, first of all, both of them have a long-term track record of giving people a return, whether it's 3.8% for silver over a 106-year period or 5 or 6 or 7% for gold over a 50-year time period. And that's really all we have for gold is since August of 71 when it was $1. And so, when it came off there, I think it actually opened up maybe at $35 an ounce. I'm not sure of the exact price. I'd have to go back and look, but those numbers are true. It's about 5.37% of what I told you. So why are we using it though? Is if you put gold and the S&P 500 together and you look at those over a long period of time, the performance is not that much lower than the stock market. It's the highest one. So let's say we look at a period of time for, let's say, 15 or 20 years, and we see gold at, let's say 6%. Let's say the stock market's, recently probably more like 10%. Well, the return for both of them together is, I believe, like over 9%. It's very close to the 10%. You're like, well, how can that be? The reason why is because of the damage that big losses have on my portfolio and your portfolio and everyone's portfolio. You can't take on big losses and it not impact the long-term returns. This is how the stock market can be break even from 1929 to 1954, or be break even from 1966 to 1982, or be break even from 2000 to 2013, pretty much. 2013 is when it finally broke up to the upside and never looked back. for the stock market, that is. So when you put those two together, you have a 2008 year where the S&P goes down 37% and gold goes up 5%, and you got a 50-50 split. Now all of a sudden you're only down 16% rather than 37%.
Got it.
That's substantial. 1 year like that has a tremendous impact on your portfolio. And that's why gold, I think, is so good. It's not just looking at the return, and saying, well, 8% for the last 50 years is what one person's saying it is. I calculated it at 5.37 from 1975. I didn't start in 71, so maybe that's unfair. However, if you look at this, it not only is it offering a return, but what it's offering is a smoother ride for your portfolio. A lot of people can't afford, nor do they want to have a 16-year gap of being break even. And so you put your money in 1966 and you're not back to break even until 1982. That's a very big and painful, yucky pill to swallow, as one of my children would say, yucky.
Hey,
but it's just
15
not
plus years at that point. Yeah.
It's not. I mean, who wants to put their money into something and put in, if you put it in 2000, you don't get your money back until 2013. You would have gotten it back briefly in 2007, very briefly, and then crashed and not back. I mean, it's just, nobody wants to do that I know of, especially people that, are looking at retirement and wanting to retire in their, 40s, 50s, and 60s, or 70s if they're already retired, or 60s if they're already retired. It's just not. So that's what gold does. It gives you it's going to give you, I think, the underwater period for gold and stocks together on a 50-50 blend was something like 3 years, most worst case scenario, which is really good. Anybody, even if you're 70 years old or even 75, you can put your money into something and be okay with not getting it back in a worst case scenario at the age of 78 or at the age of 79. 3 or 4 years to wait in a worst case scenario is okay. And you're really not giving up much. You may give up 1% a year to be able to have less break even and max drawdowns. And it's a great price to pay to give you that ability to be able to get out when you want to get out, particularly if you're doing retirement income distributions. It really can become dangerous if your portfolio takes, a 20 or 30 or even a 40% hit, and you're sitting there trying to withdraw money from it. It's not going to be pretty.
Yeah, you have those RMDs. You're talking about buy low and sell high is the old advice here, that if you have to take those required minimum distributions, keyword being required, and your portfolio is down, you are losing out by having to withdraw that money when the stocks are down. So I can definitely see where the gold would play in there. Another thing, Tommy, is we've talked about diversification in previous shows, and what I like about the idea of gold and silver or these precious metals is that it keeps you diversified. And I think you were kind of getting at this a moment ago. You have a protection against something happening bad on one side or the other. If you have stocks, you have bonds, you have precious metals. Some people have real estate investment trusts. All these different types of areas and assets that you might be invested in protects you against something going bad in one area. You can always fall back on the other areas.
That's exactly it. I love to quote King Solomon, who's been estimated to have a net worth of $2.2 trillion. Of course, with gold and silver going up, it's really driven up his net worth. And then they don't, put estimates on the slavery thing where he had all those concubines, which, they shouldn't. But $2.2 trillion of his assets that they could roughly calculate the value of what we know about him. And he said, it's said in the Bible that he asked God for wisdom and that God gave him wisdom. What King Solomon did was he diversified. He says, diversify your wealth 7 or even 8 ways because you don't know what danger is going to fall upon the earth. And that we keep quoting that over and over again. And I keep trying to emphasize that. That's how I invest my retirement funds. Mine's in real estate, gold, global stocks, and U.S. Treasuries. I try to have really good diversification because I believe that's the wisest way to invest. I think the things that are written in the Bible for us are written for our own good. They're not written to try to force us to do something that is no fun or something like that. So, yeah, gold's fantastic. Gold does not correlate with stocks, as we've talked about. And then silver has a low correlation of about 0.27 to the S&P 500. And then it has a 0.26 low correlation to the U.S. bond market, which is excellent. So that's exactly what you're trying to do. I think so many people invest with the idea of just returns, and that's good. But how are you going to get those returns? If all you do is put your money into one asset class and it goes south, as we've seen gold do, as we've seen gold do in 1980, we've seen stocks do it in 66, in 2000, 2001, 2002, 2008. We've seen silver really crash. So, we've seen U.S. Treasuries crash in the late 70s. Just interest rates were skyrocketing and Treasuries were just dropping like a rock. We've seen real estate crash in, 08, 09, 2010. Real estate went down severely. In some cities, it was down over 50%. So I think it's important for everyone to realize that what God's trying to do is to get us not to focus on money. He's trying to get us to say, you guys don't know what's going to happen. Nobody knows what's going to happen. And there's all these articles and information about people saying, well, this is going to happen. No, nobody knows what's going to happen. So just diversify what you have so you can focus on me and doing my work here on earth for other people and for my glory.
We're going to leave it there, Tommy. It's a great way to talk about diversifying, investing, gold, silver, and it goes all the way back to in the beginning, so to speak. If somebody wants to come find you at Third Act Retirement, Tommy, what are the best ways to find you?
I love it. They can go to my website, thirdactretirement.com, and just click on Get Started and schedule a Retirement Ready Success call. Or they're more than welcome to call our office toll-free at 1-800-917-5016 or locally at 770-971-2888. Anybody that answers the phone will be able to schedule a call for them with me, and there's no cost, there's no obligation. We can look at where they are and where they want to be, and I can give them a few tips that I use with my clients that might help them as well.